Rob's Child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open it for discussion. This is Chapter 48, Some Aspects of Corporate Pyramiding. It sounds like this was one of the larger issues in 1929 when people were saying that valuations were getting out of hand because, you look at a chart, PE ratios didn't even seem all that ridiculous. They seemed on the high side, historically speaking, around 20, a little over 20. But I'm starting to think that the pyramiding thing uh, may have been a bigger part of the problem. And in fact, in these metrics of PE ratios, you know, it sounds like they kind of fudged the numbers largely through these methods that he talks about in this chapter. And so the biggest takeaways coming from this are just being aware of uh, schemy kinds of things, pyramiding type of things, and you know, it's not like these things have been completely annihilated today. You still hear about pyramid schemes all the time. One particular example that in more recent history was the Enron debacle with you know, and I think that was less of a pyramiding issue. It was more regarding the previous chapter of like over promotion of, selling stocks. They're just like, um, plus I guess they fudged some of their books with getting rid of liabilities that, or took liabilities off their books that they actually had, things like that. So certainly we are not immune to people trying to take advantage of really ignorance, I guess, in the financial world and financing. But and so we can expect that in the future. And I think the biggest takeaway overall with seeing schemes continuing in the financial world is, especially, take a look at what seems like it's too good to be true. The best thing that I can the biggest thing I personally see right now is the overvaluation of so many stocks right now today. Um, including the Magnificent Seven. These PE ratios are just getting out of hand, and it's pretty clear that at some point something needs to balance out. The companies either need to actually make tons and tons more money, or the prices of the stocks actually have to drop. It's not. It can't keep going the way it's going right now. But anyway, that'll be a discussion for another day. Let's get through this chapter. So, through his first example, he's kind of illustrating that what he means by corporate pyramiding is basically having a holding company buy a company and then use the resources of that company to purchase another company. And so you're kind of stacking, um, you're using a smaller amount of resources and capital to essentially increase your power. And then another big aspect of this is somehow they were able to own a lot less percentage of the total stocks of companies and yet maintain a much higher amount of voting power within the corporations. And so um, those, I think, are two of the biggest parts of this chapter. But yeah, that's the second thing that he points out is how these companies, for example, only have 10% of the stock, which would normally mean they have 10% of the voting power, but they ended up with like 80% of the voting power. I'm not sure exactly how that worked, if it was different types of shares, or I haven't looked into it, but it doesn't, it's not all that relevant to me necessarily. But it does remind me about how even today there are often corporations with different share types. One in particular that comes to mind is Under Armour, UAA, and I believe it's UAA, or yeah, sorry, UA and UAA. One of them has voting power and the other one has no voting power. And that's, seeing these things in this chapter makes me give hesitance to, in the future, looking at corporations that are set up with capital structures that have voting and non-voting common stock. The whole point of common stock is that you're supposedly the owner, and not supposedly, you are the owners. And so if you're part of the capital structure and you don't have any actual power over the corporation with any votes, it's like, I mean, that's sort of, in my head, has to be a little bit of a scam, honestly. I mean, I understand the benefits of having non-voting shares, but um, I'm going to say Graham would not approve of that. And so that's one of the takeaways I'm kind of getting from at this point in the book, and relating it to what's going on today. And then we have an example of a holding company, which, the holding company is, what we're talking about here is a company that shareholders can buy, but it's just like a shell that owns companies inside of it. And so he points out an example of a holding company that ended up selling all of its holding and ended up wiping its shareholders of the holding company down to zero. So they lost all their value. And I guess this was happening a lot in the railroad industry. And he said that after that, what happened was, they went through courts, and it supposedly ended high finance in the railroad industry. High finance meaning, I guess we can call them shell companies. Is that what a shell company is? I guess I have some more research to do. But either way, he says, the practice basically came back another 10 years later. And even at the end of the chapter, he refers back to this and the other examples, is the bad memory the finance world tends to show time and time again. And as far as their ignorance, as far as how a lot of these things work. And I think that adds to the credence of my current thesis in the very last day of 2023, that the stock market is it's overvalued. It's very much overvalued. We're not in a normal situation, and I think that things will normalize. They have to normalize eventually. But again, I digress. Well, those will be separate videos eventually. And then, okay, no, I was wrong. That quote was actually right here in the chapter. Great quote I pulled out of here. It says, quote, and I quote, "The memory of the financial community is proverbially and distressingly short." And I want to take that even further and say how, what's interesting to me is looking at, things that have happened a long time ago, like in the Great Depression, that we are probably ignoring today. The kinds of overvaluations that we see, but going on right now. And then the speculation in crypto markets and all these other, assets that people think are just going to go up forever. And it's scary out there right now. That's all I got to say. Anyway, I digress. Then we get to a subtitle, and he writes, "Evils of Corporate Pyramiding." I found in this part interesting that they are subject to deceptively rapid increases of earning power in favorable years, and always disasters and speculation. And I guess from his perspective, he saw one after one of these types of financial setups collapsing under their own weight of essentially, deceptive earnings. They're claiming they have all these earnings, and in some ways it's like they are actually earning, but there's nothing to back it up. It's clearly like a pyramid. It's clearly a pyramid scheme. So then he goes over a list of ideas of things that are obvious, a few um, obvious reasons how these pyramid schemes can work, and then explains two of them. And one of them is, creating an overstatement of earnings. So how do they do that? So one way of doing that is overvaluing the dividends received. Like if one of their holding companies, for example, is, you know, even losing money for a year, but wants to continue their dividend payment, and so they charge the surplus account. The holdings company doesn't see any of that. They're just like, yeah, this company's pumping out dividends, and that's part of our earnings, and um, that that's actually uh, pretty manipulative. And then also, if the stock price of something the holding company has goes up and they sell it, they count that as part of their earnings too. And one of the big problems with that is a lot of these holdings companies, they're thematic based. You can have an oil one that owns oil companies, or a tobacco that owns tobacco based companies, etc. And what happens is, when that industry is expanding or taking off or doing really well, or whether it's from real earnings or a combination of that plus leveraged financing things going on because of the growth, that those turn into a situation where the growth appears to be much bigger and greater than it actually really is. So I don't see this problem specifically being a continuing specific problem today. As far as the pyramiding goes, every once in a while you'll have smaller cases of these things happening, but anyway, there's more to talk about here, so let's keep going. So one of the bad examples regarding this way of holding company, making earnings, is actually selling. Get this, he says selling one of its holdings to its own shareholders at a gain, and then reporting that gain as earnings for the holding company. Like, the people coming up with these ideas in the first place, it is evil. It's very evil. I would describe it as evil. I mean, what kind of people are going to be doing this? Like, that's just... Anyway, but they continue, things like this, like I said, seem to continue to happen all the time and catch people off guard. So then he has company A, not a real company, N63, and issuance of subscription rights, talking about how you can layer speculation on top of speculation. And the question brought up in my head, is the company... one thing I guess I wasn't understanding in this part was, are they raising money by selling these options? It sounds like they are, and that's part of the whole pyramiding idea. And then we have an example of a real company that's offering to sell preferred shares with detached warrants, and the warrants had a market value of $3, and so the public saw that as like basically a cash dividend, and it kind of is if you sell it right away like that. But all it's really doing is, I believe anyway, is diluting the stock. So diluting the value of the common shares, I think. But let's move on. He goes through another typical example, where a company of pyramiding. So this holding company owns so many shares of a company that it can easily manipulate the price of the rest of the shares. So there's only a little bit of shares left on the market, and so they can do things to push up the price of those, which makes all their entire holdings look that much bigger. Just because, if they're buying and hodling, 80% of the shares of a company, and the only shares being traded on the market are 20%. Think of it, that 80%, if they're just holding on to it, that 20% is what's determining the price. And so if they're able to manipulate the price of the smaller chunk, then it makes the whole chunk, you can make that look much, much more valuable than it otherwise would be if the holding company didn't have so many shares in its control. And then what they do with this is the holding company itself makes its book value in numerical terms, like how much the company would be, the breakup value. So if you were to sell all the assets of the company, it's using that inflated price of those shares to be like, oh yeah, we could just sell 80% of this company at the price that it's currently at of the 20% that's actually trading available on the market. And so that's obviously very deceptive. And so this gives credence to the idea, and makes me think too, like when I look at stocks as well, like to look at what are the biggest holders of the company and how much do they own. If you find there's a company that is 80% owned by one company, that should probably set off alarm bells in your head, to just be aware that the price can be much more easily manipulated by large shareholders. So that's something I think I'm going to be using for sure when I look over the data. It's something I've never thought about before. I do look at holders, like the biggest holders of securities, but I haven't thought of it that way, and I think that's a really good way to think of it. Even if it's like a combination of institutional ownership, like let's say BlackRock owns 30% of this one stock, and then some other company owns another 30%. Well, that's more than half of the entire company. At that point, you have to also just realize in your head that 60% of the control is by these institutional owners that have their own interests in mind. So it's just something to be highly conscious of. I think is a huge takeaway from this whole chapter. So then we have an example of a cigar-themed holding company doing exactly that. But not only that, the company that they're holding was being manipulative with their own stock dividends, which was talked about earlier in the book. And so then you have layers of deception on top of each other, which was especially problematic. And then we have another example of these. I'm assuming these are like the worst examples that were of these kinds of things that he could find, because this one seemed really bad. It's called the Electric Bond and Share Company. It made its earnings appear like insanely above reality in a nutshell, and various factors drove the price higher and higher. Part of it is holding warrants. His whole thing on warrants being manipulative, and and so you've got a holding company holding warrants that have a supposed market value. I mean, you can just imagine how the layers stack up on each other, and then not only that, they lever each other up. The value of the warrant goes up. I mean, I think you can follow that logic. But again, main point, in general, I think he really doesn't like, stock option warrants and how they've been used. And they're still, like I've said in the other chapters too, they're still used today, even as part of compensation, to executives and employees of companies. And you know, it, it's like it's a really interesting thing in general. It's, options as part of your compensation if you're working for a company. The fact that your compensation is relying on the success of the company and you're not just being paid for your services, it's like they're forcing you into basically being a speculator in your own company. Um, and that makes me just, you know, it makes me really slam the brakes in my brain in terms of, how is this even fair for the workers? You know, um, isn't it more fair to, if the company has more resources, to simply just pay them more, give them higher salaries? Like it's a tricky business. This whole options business. It's a very very tricky business. That's something that I'm kind of getting in my own mind from all of this. So moving on, additional to that, um, this whole discussion on companies being deceptively uh, having greater value. It just makes me think about today and how companies are being crazily overvalued, but like nobody cares anymore, and there's nothing, no one's hiding it. They used to have to hide it from people, with selling warrants and not telling the public, diluting shares basically, essentially, without the owners even knowing about it. You're losing part of your market share and you don't even know. Today, that's not even part of the problem. Um, the transparency of most corporations is pretty good. It might be as good as it can get at this point. Um, you know, and yet PE ratios can get so enormously high and people just don't care anymore. Again, this whole section of the book is just making my brain slam on the brakes, seeing these things going on and being like, alarm bells going off, thinking about what's going on today. So anyway, we have an example, another company that went through, again, the eventual normalization of a warrants value. The company had went through some big things, but eventually it settled and things got okay. I guess the shareholders weren't completely wiped out like they often are when things get schemy. And then we have a section on not the fact that not all holding companies are evil. So that section was on, he goes through several examples of holding companies that were legitimate and ran things properly. Okay, and then the examples X, if you know that one, U.S. Steel. Apparently, when they started, there was a little bit of pyramiding, but later on, they became a very good, legit holding company that was able to benefit shareholders in a healthy way. And also GM, apparently he saw, at least in that time, as largely a holding company. I'm not sure how it works today, but he approves of these two holding companies. And then we have a section on pyramiding being able to exist without holding companies. So you don't necessarily need a holding company in order for the capitalization structure to have pyramiding type of things going on. In particular, he brings up an example of parent subsidiary, where the parent company is, if I remember right, they're selling preferred shares that rely on the subsidiary earnings or something, and there can be manipulation involved with that. And so, I mean, essentially, that sounds exactly like the same thing as a holding company, right? Except, parent company owns all of their subsidiaries, not just like parts of each company. But Anyway, last point in this chapter is that he says that there have been new laws that help prevent pyramiding, because acquisitions and new financing must be basically sort of pre-approved before they're allowed to happen by commission, by the commission, by the I assume the SEC is what he's talking about there. And so, yeah, I mean, every time we go through some giant scandal, some giant scheme, eventually laws are passed and be like, okay, we can't let that happen again. You gotta make new rules, and then people figure out new ways to break those rules, and the world keeps turning. So, and then, yeah, last point he makes is that pyramids like these probably won't exist in the future, not anyway in the same exact way that they existed. Certainly, pyramid schemes have existed in various ways, not necessarily in financing, but if businesses that have that was a whole thing for a while, pyramid companies, right? Where, if you don't know about that, look into it. I grew up hearing about that all the time, and it's like almost everybody got caught in one too. It was kind of funny. But anyway, in regards to finance with pyramids, my big takeaway here is to just guard, especially against being dazzled in the finance industry. If all of your friends are telling you to invest in the same thing and it seems like too good to be true, like they're doubling their money every year for 3 years, and they're like, yeah, you just gotta put all your money in here, just gonna double forever. Anything that seems dazzling like that, being dazzled in general, he uses the word dazzled, I think should be setting off alarms in anybody's head who wants to be a successful investor or a successful security analyst. And with that, I hope you enjoyed this chapter with me. Please comment any thoughts below. That was chapter 48, some aspects of corporate pyramiding. Thank you for watching. Rob's Child.